Cold open, shock reframe. This wasn't fundamentals. This was forced behavior. A 4-digit silver price sounds absurd in a stable system. It sounds like fantasy anchored to fear. But markets do not move on belief. They move on margin rules, collateral demands, and positioning stress. When liquidity fractures, price doesn't drift higher politely. It reprices abruptly. If the recent volatility made you uneasy, that reaction is not weakness. It is awareness. Nausea in markets usually signals instability beneath the surface. Repricing events begin when paper promises multiply faster than deliverable supply. That imbalance does not resolve emotionally. It resolves mechanically. This is not a prediction of a number. It is a conditional pathway built on stress dynamics. We are entering a decision window. In a minute, I'll show you the one signal that determines direction. We measure stress points. We don't chase numbers. What actually happened? Mechanics trigger. What actually shifted was not retail enthusiasm or a viral narrative. It was positioning stress inside the futures market. Leveraged longs increased exposure into strength, while commercial participants maintained sizable short positions, creating a crowded structure on both sides. At the same time, open interest expanded as available registered inventory drifted lower. That combination matters. When paper claims per ounce rise while deliverable supply tightens, sensitivity increases. The market becomes unstable to relatively small shocks. Delivery notices began trending higher relative to shrinking registered stocks, signaling that more participants were standing for metal rather than rolling contracts forward. Layer onto that a backdrop of dollar liquidity tightening and bond volatility, which stresses collateral across the system. If yields move sharply, margin requirements adjust. When margin requirements adjust, weaker hands must either post additional capital or reduce exposure. That reduction is rarely orderly. Industrial demand quietly continues in the background. Solar manufacturing, electronics, and electric vehicle supply chains do not pause for futures volatility. They absorb float steadily. Meanwhile, ETF inflows can create headline demand, while physical withdrawals from vaults tell a different story about availability. Price spikes do not begin because buyers cheer. They begin because sellers hesitate or disappear under collateral pressure. Wait until you see what happens when open interest rises while inventories fall. The next 14 days could determine whether this evolves into structural stress. When leverage meets scarcity, price doesn't negotiate. It reprices. Why it felt violent: forced selling plus liquidity. The reason it felt violent has less to do with value and more to do with liquidity. In thin conditions, order books are shallow. When volume hits a shallow book, price moves farther than logic would suggest. That is not manipulation. It is structure. Algorithmic systems then detect momentum and amplify it, accelerating both downside and upside within seconds. The move feeds itself. When volatility rises, margin clerks do not debate narratives. They calculate exposure. If collateral values fall or volatility spikes, margin requirements increase. Traders who cannot post additional capital must reduce positions immediately. Those reductions happen at the worst possible time. That is forced selling. It does not ask whether the long-term thesis remains intact. It simply closes risk. Stop-loss orders add fuel. Once triggered, they convert intention into market orders, creating cascades that resemble panic but are actually mechanical reactions. Large funds also de-risk simultaneously when bond yields swing or equity markets wobble because risk models are correlated across assets. Silver becomes collateral damage. The market just showed its teeth. Psychologically, this phase is exhausting. It is designed to keep you staring at every tick, questioning conviction. But volatility in this context is not random hostility. It is a symptom of stress in collateral markets. Here is what matters next. Forced sellers eventually run out. When they are cleared, behavior changes. There's a phase where volatility compresses right before vertical expansion. Volatility isn't chaos. It's leverage being flushed. Facts versus interpretation, credibility ladder. Now we separate signal from story. COMEX registered inventories have been trending lower relative to recent history. A tighter float means the market becomes more sensitive to shifts in delivery demand. That does not guarantee shortage. It increases fragility. Open interest remains elevated compared to prior quiet periods. There are more paper claims per available ounce, which raises the potential impact of forced repositioning. Again, not destiny, just structure. Retail premiums tend to spike during periods of stress. The supply chain between wholesale bars and retail coins strains under sudden demand. That reflects friction, not necessarily permanent scarcity. Margin requirements adjust upward when volatility expands. Forced behavior increases because weaker hands must reduce exposure. Rules tighten when stress rises. What is not evidence of a four-digit silver price? A single breakout candle, a trending hashtag, a dramatic headline. Those are noise without structural confirmation. Price alone is insufficient. This is probability stacking. We observe conditions, not fantasies. One of these facts matters more than the others. If two specific metrics align, the math changes. Facts anchor us, interpretation keeps us flexible. The decision zone, behavior at levels. This brings us to the decision zone. Not a price target, a behavioral threshold. There's a multi-year resistance band overhead, where prior advances failed and supply consistently appeared. That region is not magical. It is memory. Traders remember pain there. Institutions remember inventory there. If price approaches that band again, the reaction tells us more than the number itself. Psychological round numbers matter because participants anchor to them. 30, 50, eventually triple digits. These levels attract attention, and attention attracts orders. But the level is not the signal. The behavior is. If price pushes through resistance and volume expands alongside rising open interest, that suggests new participation rather than short covering alone. If price rises while open interest falls, that is often a fake breakout fueled by position reduction, not structural demand. A true washout looks different. It is a sharp spike lower on extreme volume, often accompanied by rising retail premiums and heightened volatility in bond yields or the dollar index. That divergence signals stress rather than weakness in physical demand. Correlation matters. If yields surge and silver drops in tandem, collateral stress may be driving behavior. We're in a decision window over the next 2 weeks. Reaction speed matters more than the level itself. There's one level where the shorts lose control. If we stall here, expect engineered exhaustion. Levels don't matter. Behavior at levels does. Paper versus physical. Premiums, inventory, delivery. Now we address the divide most people sense but rarely quantify. Paper price versus physical strain. The futures price, often called spot, reflects the most active contract trading in leveraged markets. The retail coin price reflects fabrication costs, distribution friction, and immediate availability. In calm conditions, the gap between the two remains modest. During stress, that gap widens. Premium expansion is not random. It signals strain in sourcing and distribution. Registered inventory represents metal available for delivery against futures contracts. Eligible inventory is metal that meets exchange standards but is not committed for delivery. The distinction matters. If registered stocks decline while open interest remains elevated, sensitivity increases. Delivery requests become a stress indicator because they convert paper exposure into physical obligation. When more participants stand for delivery rather than roll forward, the system tightens incrementally. ETF share creation and redemption flows add another layer. Large inflows can imply demand, but if physical withdrawals from vaults accelerate simultaneously, that suggests metal is moving out of easily accessible pools. Industrial users complicate the picture further. Solar manufacturers and electronics firms lock forward contracts quietly. Retail investors hoard visibly. Both remove float, but at different speeds. History shows episodes where futures price stalled while premiums climbed. That divergence did not resolve immediately. It built pressure. Physical drain is rarely the initial spark. It is the slow fuse beneath the structure. If premiums rise while price stalls, something is brewing. The real tell isn't price. It's delivery behavior. Paper trades fast. Physical moves slow, then suddenly. Scenario map. Breakout versus fakeout versus washout. Now we map the terrain ahead. Not predictions, pathways. If price sustains a breakout above the multi-year resistance band and open interest expands alongside it, that suggests new participation rather than simple short covering. If premiums remain firm and delivery activity holds steady while the dollar softens and bond yields stabilize, the probability increases that the move reflects structural demand. In that environment, momentum funds begin allocating systematically. That flow can accelerate price beyond what traditional valuation models would justify, because positioning, not valuation, drives the advance. The second path is the fake-out. If price spikes above resistance but open interest contracts, that signals position reduction rather than expansion. If a margin requirement hike follows quickly, liquidity tightens and weaker longs are forced to exit. Price can retrace sharply, not because the thesis is broken, but because leverage was excessive. This is the liquidity trap. It feels like failure. Mechanically, it is compression. The third path is the washout, then higher. If price drops violently below support on extreme volume while retail premiums spike and delivery requests remain firm, that divergence signals forced liquidation in paper markets rather than collapsing physical demand. Weak hands exit. Volatility peaks. A base forms quietly as open interest stabilizes and inventories continue to trend lower. The subsequent reversal, if it comes, often carries more strength than the prior advance because leverage has been reset. None of these paths are guarantees. They are conditional sequences. If certain metrics align, probabilities shift. If they do not, the structure adapts. One of these paths is far more explosive than people expect. The washout scenario is where generational moves begin. The path matters less than your response to it. Risk, discipline, and positioning mindset. All of this analysis means little without discipline. Volatility is designed to provoke reaction. When price swings widen, the instinct is to stare at every tick and equate movement with meaning. That is how errors compound. Emotional control is not optional in stressed markets. It is structural protection. Scaling differs from chasing. Scaling implies measured allocation over time, allowing price to come to you. Chasing implies urgency driven by fear of missing out. In leveraged environments, that difference is decisive. Liquidity planning becomes critical during volatility because collateral requirements can change quickly. If margin rules tighten and capital is insufficient, exposure is reduced for you. Understanding leverage risk is not pessimism. It is realism. Patience during consolidation often feels like inactivity. It is not. It is observation. They want you impulsive. They want you responding to noise rather than structure. The disciplined framework is simple. Observe behavior, confirm signals, then respond proportionally, not aggressively, not emotionally. The biggest gains often come after the most uncomfortable pause. That pause shakes out weak conviction and excessive leverage. Discipline determines whether volatility transfers wealth or destroys it. Survival precedes opportunity. What to watch next? Signals, checklist. So what do we monitor from here? First, the relationship between price and open interest. If price advances and open interest expands, participation is increasing. If price rises while open interest contracts, that suggests short covering rather than new structural demand. That distinction matters. Next, track the trend in registered inventory. A steady decline alongside stable or rising open interest increases sensitivity in the system. Retail premium behavior is another tell. If premiums remain elevated or rise even when futures price stalls, that divergence suggests physical tightness beneath surface calm. Margin rule announcements must also be watched closely. Exchanges adjust requirements during volatility. Those adjustments change behavior immediately. Observe the dollar index. A sustained weakening can relieve pressure on commodities, while sharp dollar strength often coincides with liquidity tightening. Bond yield volatility is equally important. Rapid yield spikes can trigger collateral stress across leverage funds, impacting silver indirectly. ETF inflow and outflow data provide context. Large inflows paired with vault withdrawals suggest metal movement. Outflows during price stability may indicate rotation rather than panic. We are inside a 14-day decision window. Watch for stabilization after a volatility spike. Compression often precedes expansion. If we get another margin hike while price stabilizes, behavior could shift quickly. If inventory drops sharply during sideways price action, sensitivity increases further. Signals first, narratives second. Interactive close. So when we talk about four-digit silver, understand what we are actually discussing. Not hype, not fantasy, a stress outcome, a repricing event that would only occur if structural pressure inside the paper market collides with tightening physical supply. It is conditional. It is not guaranteed. The pathway depends on behavior, not hope. Now, I want your assessment. Do you think the next major move is more likely to come from a physical drain that slowly tightens the system, or from a sudden liquidity shock that forces rapid repositioning? And if we do see volatility expand again, would you prefer a sharp washout to reset leverage first, or a straight breakout through resistance? We will continue monitoring the signals we outlined, calmly and without emotion. If this framework helps you think clearly during volatility, subscribe and stay with us as this decision window unfolds. Because if we get another margin hike while price stabilizes, the next move could be faster than the last.